Hello, welcome to our February blog, vlog, newsletter. It's all the above, right?
Discussion. Yeah.
Discussion. Our topic this month is being organized, which sort of after the holiday rush, people start to think about getting organized. And we see it even in the industry publications a bit more. And we started to go down this road of saying, well, you should keep certain records, and you should, but most of them Most of them, like copies of your will and trust documents, if you have them, should be easy to find. Mm-hmm. Another kind of easy one that people might not think about is your utility bills or all of your regular bills. So in the case somebody needed to step in for you, they could easily find them. I have some personal experience where that was not an easy thing. But we really wanted to dig into some of the things that are less obvious. And so we have a few different highlights there. Somewhat related and somewhat not, depending on which ones they are. But the first one is, how long should you keep your tax returns? The general knowledge is 3 years, but some states require a longer holding period, which, for example, California asks for, I think, keep 5 years. But if you ever get audited, you really need 6 to 7 years of history. So I personally keep 7 years tax returns, and then I shred, every year the 8-year-old one. And that just makes sure you are covered. There's also some other ways it comes in handy, and we'll touch on that actually when we talk about some other forms that go along with your tax return.
Yeah.
But so even though people I've heard recently tend to shred them after a year or two, and I would really kind of hold on a little bit longer. It's just so you have them at your fingertips, because sometimes it comes in handy for reasons other than being audited.
Yeah. Yeah, and even the keeping of those tax returns, a lot of, I know such a huge portion of people are filing on TurboTax. Mm-hmm. They keep, a lot of them. So just having your login, having that access. Mm-hmm. So it doesn't necessarily mean it, filed in, but just know that it exists somewhere. Yeah. You could almost like audit yourself with something like tax returns and say, well, could I find my 2018 taxes right now? So maybe that's a good test, and just jumping in and seeing, does that exist anywhere in your household or your computer or somewhere?
And that can get weird too, because when you upgrade and change computers, sometimes your tax returns are on old computers.
Yeah, if it's saved on a hard drive.
I've seen many people run into that too. So it's actually better if you use some sort of cloud storage to keep them all together in a folder.
Yeah.
So
number 2 is so W-2s. This is an interesting one.
Yeah.
These are again those things that like you don't naturally think about until you have an issue and it comes up. So we had a client, a specific story with this one with W-2s is keeping old W-2s for Social Security purposes, and this was a just. They weren't filing, but for some reason were in the Social Security database and went into the wage history and just saw that they had missing years. There was years where
several missing years.
And I don't remember what it was or how that could possibly happen, but we hear stories about Social Security in some cases is maybe not the most organized organization. But if you have that data or information, you can reconcile that. So keeping W-2s from historical information just to be able to prove that, hey, I did earn money and I did pay into Social Security for these years.
So every year you have a zero earning impacts your future benefits. Mm-hmm. So if you've actually worked those years, you definitely want credit for it because it will increase your ultimate payout. Yeah. And so it was difficult, but she was able to fix it. But if you have all of your W-2s, which I don't because I didn't know this back in the day either, it will be handy for you at some point, and it's easy to keep as well. So this one's probably going to have the most discussion, which is health savings accounts. And as you probably are familiar, health savings accounts are accounts where you can put pre-tax money into an account, and that money is specifically for medical expenses. And you can use it for aspirin even, or
Band-Aids.
Yeah, probably crutches. I don't know. But anyway, you can use it for that. And what we always recommend is don't spend that money unless you absolutely have to. because you are allowed to let that money build up over time.
Yeah.
When it gets over a certain balance, you can invest it and really let it grow. And then ultimately, in your more likely to be ill years later in life, you would have quite a pot of money there that you can use tax-free to pay those medical expenses.
Yeah.
So you're like pre-saving for that. But the little known trick here is if you started contributing to a health savings account this year and you started saving all of your out-of-pocket medical expense receipts, including your copays and drugs and all of that in a file, as long as you have not deducted those costs on your tax return, you've just paid them out of pocket, no deduction, you can later reimburse yourself from the HSA tax-free because it doesn't have to be in the year you make the distribution. So it's kind of a gold mine. I mean, you really, hopefully the IRS is not listening, but you really could take that money and reimburse yourself at age 60 for thousands of dollars you've spent and go on vacation with it.
Yeah.
Really.
Yeah.
Tax-free growth and tax-free distributions. But you have to be able to prove.
Yeah.
So you need those receipts because, again, if you ever get audited, you need to be able to say, yep, these were those expenses, and you can see on the tax returns that you did not deduct. It's really unusual for people to deduct medical expenses because it has to be a high percentage of your income that year.
Yep.
So it's unlikely, unless you've had a serious health crisis, that you've deducted any medical expenses on your return. But just keep that part in mind.
Yeah. Yeah, and a lot of people, when you sign up for an HSA, you get the debit card in the mail for the HSA, and you could swipe that at Walgreens, so that's in a way getting the deduction when you're making those expenses. So that's another element to this is don't do that.
Yeah.
Let that money sit, get it invested, into something, into index funds, or if you let that money grow. Then in the future we can take this is literally the only vehicle that gives you all of the preferential tax treatment.
Yeah.
You get the deduction, you get the deferral, you get the tax-free
distribution.
I think the only thing from a saving standpoint that we would put ahead of something like this is getting your company match. And then shortly behind that is something like an HSA.
Yeah.
There's no other vehicle that can do that.
In 2023, a family can put $7,200 into an HSA. So they limit how much you can put in every year because it's a gold mine. But definitely maximize your contributions to that particular vehicle if it is available to you. They only accompany high deductible medical insurance plans. So they're not actually available for everyone.
Yeah.
But the industry seems to be going that way.
It's definitely moving that direction. Yep.
Yeah. So, sorry, we got a little list here, and it's a little tiny print. But
yeah. What's next?
The Medicare summary.
Yeah. So, if you're on Medicare, this is just after they file, right? Is to keep those Medicare summaries for a regular period. I think at least a year is the recommendation.
Or unless it's been paid, right? Just make sure you get paid before you get rid of those summaries.
Yes,
because they go into a review, and then eventually it works its way through the system, and it should get paid. But it's worth holding on to, especially if you have higher medical expenses. And sort of what's part of that is. When you're working, you should get a notice of creditable coverage of your health insurance every year, because you have to tell the government that you have medical insurance. It was part of the Affordable Care Act, also known as Obamacare, that you're required to have medical insurance. So now we have to prove we have it. And in order to get Part D coverage for Medicare, you need that form. So you really need to hold it. It should be with your tax return every year. Another reason, hold on to your tax return, but just kind of bear that in mind. So I kind of stole half of yours.
Yeah, that one's always kind of confused me, because that's not one that I'm used to seeing, or when it comes across and thinking that this is something that is important. Yeah. But
I've been in situations where it's very important.
Yes.
So one thing to also is make sure your marriage certificate is where you can find it.
Yeah.
And I know that sounds weird, especially if you've been married a long time. But we've had a situation where a client was married for decades, but the Social Security Administration did not know that. It had never been put on record. And so this woman, it was a woman, and she had Social Security earnings of her own. So she was taking her own benefit, which was more than half of her spouse's benefit. So it never kind of became an issue when they were both living. But then her husband died, and his benefit was much higher. And legally, she's entitled to his higher benefit rather than her own. But the Social Security Administration didn't know they were married, and they wouldn't give it to her. So they had to go back through old county records. I mean, it took a lot of effort and time to fix the situation, which they did, but it was a lot harder than saying, here's a copy of my marriage certificate.
Yeah.
And kind of paired with that is, if you were divorced, keep a copy of a divorce decree where you can find it. Also for Social Security reasons, because you are entitled, even if you're divorced and if you've been married 10 years, to half of your ex-spouse's benefit if it's higher than your own benefit. And ultimately, you can get the spouse's benefit, right?
Yeah, depending on, if we were not ever remarrying. Yep.
That just stuck in my brain as funny. But you could technically have several ex-spouses who all can be a benefit. If you've been married long enough to each of them, they all have that access.
Yeah. So definitely an element to keep. That's definitely one of those that you hear it, and it's of course you should keep your marriage certificate. But I would bet a lot of people watching are thinking, wait, where is my marriage certificate?
I know. Well, as many of you know, I'm not married for the second time. My first husband died a few years ago, and I needed it for something, and I finally figured out I had framed it. And I had to rip it out of the frame because I didn't know where. Anyway, so that probably wasn't the best thing to do. But anyway, so we get to go on to Roth stuff.
Yeah, so this one is another one that we've recently seen in a couple different elements with clients. But if you've made any kind of Roth conversions, tracking that or keeping record of those Roth conversions is an important thing. From several different angles, but one of the ones that we know of, especially prior to 59 and a half, when the penalty to access IRA money goes away, so you reach that age. If you make Roth conversions prior to that, every conversion starts this 5-year window. I guess we won't get into the details around kind of those conversions or contributions to a Roth and how that works. But because of that 5-year window, keeping track of when Roth conversions take place is an important element, because you don't want to be penalized for accessing that money after that. It has to be at least that 5-year window before that 10% penalty falls off.
Normally Roth contribution money, you can access at any point in time after you put the money in, penalty free, because you've already paid taxes on that.
Right.
You can't access the growth at any time penalty free, but because of that 5-year clock, you need to keep track of that, any conversions you do.
Yeah, it's a weird. Without that 5-year window, it could be a little loophole where you could get around that 10% penalty. So that's why that 5-year window exists on those Roth conversions. So that's the importance of kind of keeping track of that.
I'd also add, just keep track of how many Roth contributions, if you're eligible to make them and you make them, because then you know your basis, how much you've contributed and how much you can access penalty free at any time.
Yeah.
So just keeping track of that too.
Yep.
Which should also be on your tax return. It's amazing how this is all centered around taxes and Social Security. So speaking of tax returns, if you make a contribution to your traditional IRA and it is not deductible because you are participating or eligible to participate in your employer retirement plan, you need to file an 8606 form with your tax return. And that tells the IRS that you've already paid taxes on that money. Mm-hmm. So non-deductible is you can't deduct it off your income taxes. So, and what happens later on, if the government does not know that you have already paid taxes on that money, via that form, that's kind of the only way you can prove it.
Yeah.
Is if they don't know, when you make distributions later, you have to pay taxes on that money again. So it really does, it can, especially if you are a regular contributor to non-deductible IRA.
Yep.
They're not necessarily a different kind of IRA. It can really become important later that you've kept track of that and that the IRS is aware of that's how that money comes out. It just saves you taxes in the long run.
Yeah, and the institution is not doing that. When you take money out of any IRA, like if we use TD Ameritrade as our custodian, TD Ameritrade is going to send the same form that to you from a tax perspective. It's just really saying, hey, you took this money out of your IRA. They don't know how much of it was non-deductible contribution. So from a tax perspective, they're not going to have that information, and the onus is on you when you go to file to be able to prove with that 8606 that this dollar amount was all contributed after tax, non-deductible. So you don't have to pay taxes twice.
Yeah. And the 8606 keeps a running total.
Mm-hmm.
So it's probably good to keep your old 8606s even after you've shredded the 10-year-old tax return. But it should keep a running total so your current year has all the contributions you've made that were non-deductible.
Yeah, I think the way that shows up is you'll see on the 8606, it basically takes last year's balance and you're just adding to it.
Yeah, for sure.
Yep.
All right, last one.
Yeah, last one. This is one that I think probably doesn't need to come up too often, but keeping track of improvements to your home, right? Is that the last one? Yes. Mm-hmm. From a dollar standpoint, I guess there's the tax treatment of selling a house. So after you've lived in your house for however long, and you're selling it and moving to wherever, it really doesn't matter. Moving into a retirement home or just downsizing or moving to a different state. It doesn't matter what it is. There's as far as the IRS is concerned, there's if you're single, $250,000 exclusion, or I guess exemption for the increased value of your home. So you buy a house today for $100,000 and a decade later we sell it for $300,000. We've got a $200,000 gain, right? So your basis, what you paid for the house, you've increased the sale of that. So now we've got taxes on a portion of that sale as a capital gain. However, any kind of improvements that you make to your house, you're adding to the basis. You're essentially pouring money back into that asset. Your house is an asset. So keeping track of those just in the event that you possibly trip that gain on your house.
Yeah, if you're single, the first $250,000 in gain is exempt from taxes no matter what.
And has that changed possibly historically? I
Yes,
don't know. Is that
it used to be. And then if you're married, it's $500,000.
Yeah.
It used to be as long as you bought another property and rolled the value, you never paid the gain.
Oh, right. Yeah. Okay.
So that changed. It's been several years. I don't remember.
Has that
what
exemption increased? Do they put like an inflation factor on that or anything? Or has it been $500 for?
It's been that as long as I can remember them changing the law.
That could potentially change.
It could.
There's that. But yes.
Yeah. So if you've got a $300,000 gain and you're single, you would pay taxes on $50,000 unless you can prove you've added value to the home. Mm-hmm. And that doesn't mean like painting the kitchen. It means like putting on an addition, finishing the attic. It's got to be an actual change to the structure of some way.
Yeah.
Replacing your roof doesn't count because that's part of the house already.
Right.
That sort of thing. But those can be almost impossible to recreate, those receipts, if you don't keep them all along. And you don't have to prove it with your tax return that you've done that. If you had a $300,000 gain and you said, I don't have to pay taxes on any of it, you don't have to prove it unless you get audited. And that's why you absolutely have to have the receipts. Otherwise, don't even try it. But so it is important. So there's lots of these little nuances of things that are worth holding on to. And I know personally I get in this, I'm cleaning out everything in front of me, but be careful what you actually do clean out, because some things are much more important than you might realize at the time.
Yep.
So thank you for joining us, and we'll talk to you soon.
Yeah, next time. Thanks.
Thanks. Bye.